Hello, I'm Larry Pond. I'm a CPA and a certified financial planner. Today, we're going to talk about the SALT deduction workaround and the new state tax credits, which were recently enacted by Assembly Bill 150. Hi, I'm Larry Pond. I'm a CPA and certified financial planner. I'm in my 35th tax season. I enjoy talking about tax topics. And let's go into our program today. Well, thank you for your time. So we're going to talk about AB 150, which was recently signed by the governor. And most significantly, what this law does is it provides a new pass-through entity law that can save federal taxes. It's a pretty interesting deal because this law helps reduce your federal tax. It makes no difference on your California taxes. You'll still pay the same amount of California taxes, which is why a lot of these bills have unanimous approval from the legislatures because it's not going to cost the state any money. California is about the 17th state to enact this law, so we're certainly not the first. What this workaround does is it gets around the $10,000 state and local tax limitation that was imposed by the Tax Cut and Jobs Act, which was enacted back in 2017. So if you have state income taxes and property taxes in excess of $10,000, we can only deduct $10,000. So that's been kind of a disappointment for our itemized deductions for the last couple of years. So what this law does is it provides a workaround for the federal $10,000 state and local tax limitation by qualifying S corporation, partnership, and LLC owners. So this is effective for 2021 through 2025, unless the SALT limitation is repealed. And what it does is the pass-through entity can make an election to pay a tax equal to 9.3% on its qualified net income. And so the way it works is it reduces the federal net income that's reported on Form K-1. However, the California K-1 will report the entire amount. But on the California return, there will be a tax credit equal to state tax paid by the pass-through entity on behalf of the owner. So back in November of 2020, the IRS issued Notice 2020-75. And what this notice provided was like a stamp of approval to these type of pass-through entity taxes. So we got kind of a blessing from the IRS. So back in November, the first state to implement this was Connecticut. Then New Jersey implemented their version. And then a number of other states have done that. California's recently did it. So we're one of the last states to implement this law. But as part of this notice, the IRS is supposed to be issuing proposed implementing regulations, which gives us a little more detail on how to do this. We haven't gotten that yet, so we'll keep an eye out for it. But what the notice did was it clarified the tax treatment for the entity and for the owner's tax returns. And so what the notice says that the pass-through entity would deduct the tax in the year the tax is paid, and that the tax payment would reduce the pass-through entity's distributable net income reported on the owner's K-1 for the year the tax is paid. So for example, if the payment was made in 2022 for the 21 tax year, then the deduction would be on the 22 tax return and the deduction passed through on the 22 K-1. So we're needing some more guidance on this, on the timing issues about these deductions and write-offs. So what this tells me is that if we want to take the deduction in 21, if we want to take the credit in 21, we're going to have to make these payments in 21. So that's what we're going to do here. So who are the qualified entities? The qualified entities are partnerships and S corporations. And LLCs are taxed as partnerships, so they do fit into that. But the entity's owners must be corporations, individuals, estates, and trusts. Partnership owners cannot make the election. So a partnership cannot be an owner of these pass-through entities. So that's not possible there. How about living trusts? We don't know for sure, so we need some more guidance about living trusts. Can living trusts qualify? We don't know for sure. However, what we do know is that single member LLCs cannot make this election. So therefore, just by setting up a single member LLC, we cannot take advantage of this. So here's the example of how to make this work. So for example, let's say we have an LLC. Its qualified net income is $100,000. So we make a 9.3% payment to the franchise tax board. So 9.3% is $9,300. So the K1 is going to report the $100,000 of income minus the $9,300 equals $90,700. That's going to be reported as income. So that's how we get around this $10,000 limit, because it's being deducted at the K1 level. However, on the California K1, the taxable income is still going to be $100,000 because there's no deduction for state taxes on state tax returns. However, there's going to be a $9,300 credit against the California income tax. Now we're waiting for guidance, instructions, and forms from the Franchise Tax Board. So we don't have any specific guidance and mechanics of how to do this. So we're waiting for guidance from the Franchise Tax Board. And when we do, we'll certainly give you an update on that. So not only is there this pass-through entity workaround, but also there's the tax credits that are provided by AB 150. The first one is the Main Street hiring credit. You have to reserve these credits with the CDTFA. It begins on November 1st and it ends on November 30th. Or when the $70 million that was allocated to this program is all used up, which means if you want to take advantage of this credit, apply as early as possible, because we don't know how long it's going to last. Because a lot of times when the state has these kind of credits, they go really quickly. It's for businesses that have 500 or fewer employees as of 12/31/20, and you experience a 20% or more decrease in gross receipts when comparing gross receipts for the 2020 calendar year to the 2019 calendar year. And you get $1,000 for each net increase in qualified employees, up to $150,000 maximum per taxpayer. And this credit can be claimed against personal income tax, corporate income tax, franchise taxes, and sales or use tax liability. So it's a very flexible credit here. We got this homeless person hiring credit. So you got to pay wages that are at least 120% of the state minimum wage. It's effective for 2022 to 2026. And the credit depends on how many hours this person works during the taxable year. If it's at least $500 hours and less than 1,000 hours, that's a $2,500 credit. Between 1,000 and 1,500 hours, 5,000 credit. 1,500 to 2,000 is $7,500 credit. Or this person is a full-time employee, more than 2,000 hours, that's a $10,000 credit. This credit is kept at $30,000 per taxpayer per year. So the eligible people are those that are homeless on the date of hire or anytime during the 180-day period immediately prior to the date of hire, or is receiving supported services from a designated homeless services provider. Then under SB or Senate Bill 139, we have the second round of the Golden State stimulus rebate payments. So it's for qualified taxpayers with adjusted gross incomes of $75,000 or less. The cap is $1,100. It's not including California taxable income. To get it, you have to file a California return by October 15th of 2021. Must be a California resident for at least half of 2020 and must be a California resident on the date the rebate is issued. And you cannot be claimed as a dependent, and you must have wages subject to California withholding of $75,000 or less. So we have two rounds of the stimulus. So the first round, if your income was less than $30,000, you got $600. If your income is between 30 and 75, you got nothing because it capped at 30. But second round, if your income is 30,000 or less, you get an extra $500. If you had a dependent, nothing without dependent. But between 30,000 and 75, with dependents, that's $1,100. Without dependents, is $600. So that's through the Franchise Tax Board. So the people who don't qualify are those without dependents, and you're single, and you're either deceased or incarcerated. So if you met those conditions, you're not going to get the stimulus. Then we had SB 151 that gave more grants for COVID-related businesses. We got the expanded California Small Business COVID-19 Relief Grant Program. That's between $5,000 and $25,000. Go to careliefgrant.com to apply for these. And these includes nonprofit cultural institutions. The grant's not taxable for California purposes, but it is taxable for federal purposes. There's the California Competes Grant Program. That's if you create at least 500 new full-time jobs in California, you invest at least $10 million in California infrastructure over the next 5 years, and you create jobs or make investments in high poverty areas or high unemployment areas in California. So this is administered by GoBiz, the Governor's Office of Business and Economic Development. So go to their website for the application for this program if you qualify. There's the California Venue Grant Program. That's up to $250,000 for independent venues that put on live performing arts and sporting events. So we're pretty familiar with those kind of businesses. You must have a 70% drop in gross revenue during 2020 compared to 2019. This program is administered by CalOSBA, California Office of Small Business Advocate. The California Micro Business COVID-19 Relief Grant Program. These are for our very small businesses. It's $2,500 in non-taxable grants. You have less than $50,000 of revenue in 2019, less than 5 employees. Also administered by CalOSBA. And then for nonprofit performing arts grants, you can get up to $75,000. That's administered by GoBiz. So money has been allocated for these programs to help businesses in California. So it's a good idea to take a look at what can apply to you. So thank you for your time today. We'll update this as we get additional information. But if you think the pastoral entity workaround might work for you, let us know. We're here to help you with that. And we'll see what we can do, see if it applies to you, and see if it can help reduce your tax bill. Well, thank you very much, and I'll see you again. Thank you very much.